Chapter 11 covers S corporations. Our first video is about how to elect S corporation status and generally how the S corporations will operate. An S corporation is a corporation that qualifies and has elected to be treated as a pass-through entity like a partnership. The name comes from the subchapter of the Internal Revenue Code that governs how it is taxed. C corporations, the corporations that we discussed in the first 2/3 of this course, income is taxed at the corporate level. You know how to do that, 21% of taxable income for the corporation. S corporations, generally the income will pass through to the stockholder. There are such things as S corporation taxes, but the primary taxation of an S corporation is by passing the income through to the stockholder. C corporations, distributions of earnings and profits are taxed as dividends. Distributions of S corporations are generally not taxed. S corporations are taxed like partnerships, but they are not partnerships. The rules in subchapter S are similar to, but not the same as, the partnership rules, which are in subchapter K. You may remember all those sections starting with a 7 for the partnerships, like the 754 election and the 731 transfer of assets, etc. That's all subchapter K. S corporations are governed by subchapter S, where all the section numbers start with a 13. Whenever subchapter S is silent, follow the rules for a regular C corporation. That's going to be fairly rare. You're probably not going to see many situations where you don't have guidance in subchapter S. But if you don't, go with subchapter C. An S corporation does not pay the regular corporate income tax. It also doesn't pay a personal holding company tax or an accumulated earnings tax. Now, we haven't covered either of those taxes. They are mentioned just briefly in the text, but there's about a half a page on both of them together, so we didn't cover that in this course. An S corporation may have to pay a built-in gains tax. We will talk about that in our second S corporation video. There's also something called the LIFO recapture tax, as well as a passive investment income penalty tax. And we'll discuss all three of those in our second video. For a corporation to qualify to be an S corporation, it must have the following features. It must be a domestic corporation, so no foreign S corporation. It must be in a business other than banking or insurance. Banking and insurance have their own separate tax rules that we don't cover in this course, but you can't have an S corporation if it's doing either of those two things. S corporation can have no more than 100 stockholders, and only individuals, estates, and certain trusts can be stockholders of an S corporation. There must be no non-resident alien stockholders, and there must be only one class of stock. The number of stockholders, we said the limit is 100. You can count spouses as one stockholder as long as they remain spouses. So if you have exactly 100 stockholders, counting husband and wife as one stockholder, and they get divorced, now you've got 101 stockholders and you no longer qualify as an S corporation. Count the estate of a decedent and a surviving spouse as one stockholder. So it wouldn't be fair to say, nope, it can't be an S corporation anymore because one of the spouses died. Permitted types of stockholders, individuals, estates, certain trusts owned entirely by one individual will be okay. A trust created pursuant to a will be okay for a while, although there is a time limit on that one. Or a voting trust. Anything that just is about who has the voting power, subchapter S doesn't care about. The subchapter only cares about the ownership of the assets and income of the corporation, not about the power to vote in the corporation. One class of stock, that means only one class of stock issued and outstanding. You can have other classes that are unissued or only in treasury stock, as long as there are no outstanding shares. Stock options, warrants, and convertible debt are allowed. Got to make sure that convertible debt is not convertible into a disallowed class of stock, or some debt holder is going to convert it and suddenly your S corporation isn't an S corporation anymore. So watch out for that. Or for options to buy a second class of stock. That also could get you in trouble if somebody exercises the option. Differences in voting rights will not by themselves create a separate class of stock. Again, subchapter S doesn't care about voting rights. Once you're qualified, then the question is, do you want this corporation to be an S corporation? If so, you can make the election. File form 2553, that's how you make the election. Time requirement, you can do it any time in the previous year. So if you want to turn your corporation into an S corporation starting January 1, 2026, you can do it any time in 2025. Or by the 15th day of the third month of the current year. So as long as it's not March 15th yet, then you can elect S corporation status for the current calendar year. If it's the first year of existence, then you have 2.5 months from the first day that the corporation had stockholders, had assets, or began doing business, whichever of those happens first. Consent is required from all stockholders, including any who were stockholders earlier in the affected year. So you've got until March 15th if it's a calendar year corporation. Anybody who was a stockholder from January 1 to March 15th, even if they're not a stockholder anymore, must consent to making that corporation an S corporation. Because, of course, if it's an S corporation effective January 1, they're going to have income from that corporation probably, and they would need to consent to that corporation being an S corporation. Termination of the election is possible. It can be voluntary. We just decided we don't want to be an S corporation anymore. That may be made by stockholders holding a majority of the stock for the next tax year. So you don't need unanimous consent. You need unanimous consent going in. You only need a majority to get out. It could be effective for the current year if made within 2.5 months of the beginning of the year. March 15th again, you can go retroactive back to the beginning of the year. It may be made effective on a date other than the normal year end. This would result in 2 short years. First, the S Corp year ending the day before the effective date, and secondly, the C Corp year beginning on the effective date and ending whenever the C corporation's tax year ends. Involuntary termination can occur if a qualifying condition is violated. Suddenly you have more than 100 shareholders because 2 of your married shareholders got a divorce, perhaps. Or a second class of stock is issued. Or a non-qualified person becomes a stockholder. Somebody sells their stock to a Canadian citizen who lives in Toronto. You can be a resident of the U.S. and a Canadian citizen and be a stockholder, or you can be a U.S. citizen living in Toronto and be a stockholder, but you cannot be a Canadian citizen living in Toronto and be a stockholder of a U.S. S corporation. Termination would be effective here on the date of the disqualifying event, the date that one of our stockholders sold the stock to the Torontonian. There's also a passive investment income limitation which could cause a termination of the S corporation status. That would be an automatic termination if the corporation had undistributed earnings and profit. So it was a C corporation for a while and accumulated some earnings and profits before electing S corporation status, and its gross passive investment income exceeds 25% of gross receipts. If that happens for 3 consecutive years, then the corporation is no longer an S corporation. The point of this is that corporations are supposed to be business entities. If you have passive investment income from stocks and bonds and that whole thing. You can have a little of it, but if you have more than 25% of your gross receipts, then you have excess passive investment income. That's supposed to be held by individuals, not corporations. And so they say, no, no, no. If you're going to do that, then don't be a corporation. Be an individual. Have your individuals own that passive investment. So distribute it to the individuals. It's not what an S corporation is for. So if you exceed 25% of gross receipts for 3 consecutive years, your S corporation status is eliminated until you fix it. You can re-elect after termination. The general rule is you have to wait 5 years before a new election of an S corporation status will be allowed. But exceptions are allowed if the event that caused the termination was not within the control of the corporation or the holders of the majority of its stock. One of our 2% stockholders sold the stock to a Canadian citizen living in Toronto. Well, that wasn't in the control of the majority of the stockholders, and so you fix it, and you can go back to S corporation status pretty much right away if you want. Or the ownership of the corporation stock has changed by more than 50%. So even if you violated the passive investment income rule for 3 years running, hard to say that that was not within the control of the majority owners of the stock. But if that ownership has changed and the new people come in and say, we want to be an S corporation again, then the exception would be allowed. I don't think it would be allowed if the people who were running it were still in the majority ownership if they violated the passive investment income rule. They'd have to make some very good excuse for why they allowed that to happen 3 years in a row and didn't fix it. S corporation operating rules. An S corporation must show a business purpose to use a year other than the calendar year. If they can't show a business purpose for a non-calendar year, they have to be January 1 to December 31. Because the stockholders are virtually all individuals, except for an occasional estate or trust, and individuals are virtually always calendar year taxpayers. Similar to a C corporation, an S corporation may deduct salaries, payroll taxes, fringe benefits of owners. That's something a partnership cannot do. S corporation also recognizes gain on the distribution of appreciated property, just like a C corporation. C corporation has to pay tax on that gain. The S corporation passes through the gain to its stockholders, but it does have to recognize the gain at the corporate level. Similar to a partnership, no dividends received deduction is allowed. Although it is allowed for a C corporation, it is not allowed for an S corporation. Each stockholder is allocated a pro rata share of the corporation's non-separately stated ordinary income or loss. That's very similar to the partnership, where you have ordinary income or loss, and then you have a lot of specially allocated items of income or deductions. Separately stated items for an S corporation would be such things as capital gains and losses, 1231 gains and losses, charitable contributions, and there's a much longer list. That's very similar to what partnerships have for those sorts of things, which the taxpayers can take and put on their own return, but they won't just be ordinary income from the business entity. Each item is allocated to the stockholders based on the number of shares held. That's why there can only be one class of stock. If you've got common and preferred stock in your S corporation, how are you going to allocate the non-separately stated income or loss, or the capital gains, or the 1231 gains, or anything else? With one class of stock, you just do it on the basis of the number of shares held. If the number of shares outstanding changes during the year, then it can get somewhat more involved how to do the allocation. What you do is divide the item, say the capital gain or the dividend income or the non-separately stated income, by the number of days and the number of outstanding shares that were outstanding on each day. So you get it down to the smallest level of amount per share per day. Then for each stockholder, multiply by the shares held and sum over the number of days that the stockholder owned stock. Now, if you've got two stockholders and they each own 50% of the stock all year long, then all the items are just divided 50-50. But if you have changes in the ownership during the year, well, this is your rule that will work no matter how many complicated changes in number of shares you've had during the year. Just break it down to shares outstanding per day and then sum it back up for however many days your particular shareholder owns stock. Let's take a look at problem number 20 from chapter 11. The profit and loss statement of Kitch Limited and S Corporation shows $100,000 of book income. Now that book income is actually also going to be taxable income. There are a lot of different rules between accounting book income for financial accounting purposes and income tax book income. We're talking here about income tax book income. Book income computed using the tax rules. So maker's depreciation, for example, and all the other tax rules. Kitch is owned equally by 4 shareholders. From supplemental data, you have the following information about items that are included in book income. And it's not going to be an exhaustive list, I can tell you right away. But it will have items that are separately stated as well as some that are components of non-separately stated income. So we have selling expenses. Well, that is going to be non-separately stated, and the amount is $21,200. It's an expense, so we'll put it in brackets. Tax-exempt interest, that's going to have to be separately stated, and the amount for the tax-exempt interest is $3,000. That, by the way, is the corporate amount, not per shareholder. Dividends received, that's also separately stated at $9,000. The 1231 gain, that has to be separately stated at $7,000 because, of course, 1231 gains are capital gains unless the shareholder has 1231 losses, then maybe not. Depreciation recapture, well, that's just ordinary income. If you sold an asset, like a piece of equipment, for more than its face value, then the gain is going to be ordinary gain up to the amount of depreciation deducted. For virtually all Section 1245 property, the entire gain is going to be ordinary income. In this case, we have $11,000 of depreciation recapture. That's just ordinary income, so we'll put it in with the non-separately stated items. Passive real estate rent income. That has to be separately stated because passive rent income is going to be treated differently from ordinary income on the individual's income tax return. Long-term capital loss, yes, that has to be separately stated as well for the same reason as the 1231 gain. We also have salaries to owners. That deduction is a non-separately stated item. It's only $12,000. Obviously, the owners have other sources of income besides their salaries. Cost of goods sold is $91,000. Now we know that book income is $100,000, so we know there must be something missing from non-separately stated items because we have a massive loss here now, and the separately stated items are certainly not going to make up for that. One of the things that's clearly missing is revenue. We have cost of goods sold, we have no sales. Anyway, or we have selling expenses, but no sales. So revenue is clearly missing, and there may be other things too. We don't know. We will assume, however, they don't actually say this, but we have to assume that the separately stated items have been listed in their entirety. And if you total them up, 3 plus 9 plus 7 is 19, plus 5 minus 6 is 18, $18,000 of separately stated items. And we will assume that that is an exhaustive list, even though we know there's missing pieces in the non-separately stated income. We'll assume that the separately stated items are all there. Because the question in letter A is compute non-separately stated income or loss for the tax year. Well, how can we do that if they didn't give us sales? We can do it if we assume that that is an exhaustive list of the separately stated items. It's those 5 and no more. Our book income, they told us, and again, that's book income using tax rules, is $100,000. If we pull out the separately stated items of $18,000, then what we're left must be the non-separately stated income of $82,000. That's what they're getting at there. Normally, you wouldn't compute non-separately stated income that way. You'd say sales revenue minus cost of goods sold minus selling expenses, officers' salaries, etc., until you get down to net income from operations that is not separately stated items. But here we backed into it with the book income and the separately stated items. Letter B. What would be the share of this year's non-separately stated income or loss items for James Billings, one of Kit's shareholders? They said there are 4 shareholders, each owning 25% of the corporation. So take that 82,000, multiply by 25%, and you get 20,500. That is James's non-separately stated income from the corporation. Letter C. What is James Billings' share of tax-exempt interest income, if any? Is the income taxable to him this year? Well, it's $3,000 as tax-exempt income. His 25% share is $750, and it's tax-exempt income. It retains that character when you pass it through to the shareholder, so it is not taxable. Let's take a look at problem number 21. Zebra Inc., a calendar year S corporation, incurred the following items this year, and Sammy is a 40% Zebra shareholder throughout the year. Now we've got an exhaustive list of separately stated and non-separately stated items. So we've got the whole thing here. Sales revenue is a non-separately stated item at $100,000. Cost of goods sold is $40,000. Maker's depreciation, that's a non-separately stated item at $10,000, and administrative expenses also non-separately stated at $5,000. 1231 gain, well, that's going to be a separately stated item, and that is $21,000. Depreciation recapture income, again, that's non-separately stated, it's just ordinary 1245 income, $25,000. Short-term capital loss from a stock sale, separately stated, no doubt, and that is $6,000. Long-term capital loss from a stock sale is $4,000, and there's also a long-term capital gain from a stock sale of $15,000. So the net long-term capital gain is $11,000. I netted those mainly because I'm running out of room. I don't have enough room on the screen for everything. We only have one more. Charitable contributions, and as we saw before, that is going to be a separately stated item. That's going to show up as an itemized deduction on the stockholder's individual 1040s. Now we can take a total of the non-separately stated items, because we've got the total here, and it works out to be $70,000. $125,000 of income and $55,000 of deductible expenses. So $70,000 non-separately stated income. So letter A, calculate Sammy's share of Zebra's non-separately stated income. $70,000, he has a 40% ownership, so that's $28,000. Letter B, calculate Sammy's share of any Zebra long-term capital gain, if any. So that's our $11,000. 40% of $11,000 is $4,400. And letter C, Sammy's share of charitable contributions, $4,500. 40% of $4,500 is $1,800. So there you go. Those 3 things will show up on Sammy's K1. Non-separately stated income of $28,000, a long-term capital gain of $4,400, and charitable contributions of $1,800. That'll also be that short-term capital loss that will be there, his 40% interest in that as well. And that is it for our first video on electing the S corporation status, and then some on just how to deal with day-to-day operations and how to report them at the end of the year.